Cryptocurrency investing, at its core, represents a profound shift in how we think about money, ownership, and financial systems. In the 2026 global economy, where digital infrastructure underpins everything from banking to commerce, cryptocurrencies have evolved from a niche technological curiosity into a legitimate, though highly volatile, asset class. For beginners, the challenge is not merely understanding how to buy digital coins, but how to approach this space with a disciplined, strategic mindset that balances opportunity with risk. To begin, it is essential to understand what cryptocurrency actually is. Unlike traditional currencies issued by governments, cryptocurrencies are decentralized digital assets that operate on blockchain technology, a distributed ledger system that records transactions transparently and securely. These assets are not backed by physical commodities or central banks. Instead, their value is determined by supply, demand, utility, and market sentiment. This alone introduces a level of uncertainty that beginners must fully appreciate. When entering the cryptocurrency market, investors typically begin with the most straightforward approach, buying and holding digital assets directly. For example, an individual might purchase Bitcoin at $40,000 and hold it for several years, hoping its value appreciates over time. This strategy, often referred to as hodling in crypto culture, mirrors long-term investing in stocks. However, unlike traditional equities, cryptocurrencies can experience extreme price swings within short periods. It is not uncommon for a coin to rise or fall by 10 to 20% in a single day. This volatility is both the source of potential high returns and the primary risk.
Beyond direct ownership, there are more diversified ways to gain exposure to the crypto ecosystem. One approach is investing in companies that are deeply involved in cryptocurrency infrastructure. For instance, firms like PayPal Holdings Inc. and Robinhood Markets Inc. allow users to buy and sell cryptocurrencies, thereby benefiting from increased adoption. Similarly, companies such as MicroStrategy Inc. have incorporated large amounts of Bitcoin into their corporate balance sheets, effectively turning themselves into indirect crypto investment vehicles. This method can reduce some of the risks associated with holding individual coins, while still capturing industry growth. Another increasingly popular route, especially in the post-2024 regulatory environment, is investing through exchange-traded funds, ETFs, that track cryptocurrency prices. These financial instruments allow investors to gain exposure to crypto markets without directly owning digital assets or managing private keys. For example, Bitcoin spot ETFs, approved in recent years, hold actual Bitcoin and offer shares that reflect its market price. This development has significantly increased institutional participation and has made crypto investing more accessible to traditional investors across the United States and Europe.
For those seeking tax advantages, integrating cryptocurrency into retirement accounts, such as Roth IRAs in the US, has become a viable option. This allows long-term investors to potentially benefit from tax-free gains, although such strategies require careful planning and a clear understanding of regulatory frameworks. A more technical and less common approach involves becoming a crypto miner or validator. In blockchain networks, miners and validators play a crucial role in verifying transactions and maintaining network security. In return, they receive cryptocurrency rewards. While this may sound appealing, it requires significant technical knowledge, capital investment in hardware, and access to low-cost energy, making it less suitable for beginners. However, regardless of the investment route chosen, one principle remains non-negotiable: risk management. Cryptocurrency is one of the most volatile asset classes in the modern financial system. Prices are influenced not only by market demand, but also by regulatory announcements, technological developments, macroeconomic trends, and even social media sentiment. For example, a single regulatory decision by a major economy can trigger sharp market declines, while institutional adoption can drive rapid price increases.
This leads to a critical rule for beginners. Never invest more than you can afford to lose. Unlike traditional investments, cryptocurrencies do not offer guaranteed returns, dividends, or intrinsic valuation models. In extreme scenarios, certain digital assets can lose most or all of their value. Therefore, crypto should typically represent only a small portion of a well-diversified portfolio, often suggested between 1 and 10% depending on an individual's risk tolerance.
In addition to volatility, investors must also consider transaction costs and security risks. Cryptocurrency exchanges charge fees for buying, selling, and transferring assets, and these fees can vary significantly. Moreover, the responsibility of securing digital assets lies largely with the investor. Losing access to a private key or falling victim to a cyber attack can result in permanent loss of funds. This makes secure storage, whether through hardware wallets or reputable platforms, an essential component of crypto investing. Equally important is the need for continuous learning and adaptability. The cryptocurrency landscape evolves at an extraordinary pace. New technologies such as decentralized finance, DeFi, non-fungible tokens, NFTs, and blockchain-based applications are constantly reshaping the ecosystem. At the same time, governments and regulatory bodies are actively developing frameworks to oversee this space. In 2026, regulation is becoming more structured, particularly in Europe and North America, which adds both legitimacy and complexity to the market.
From a behavioral perspective, one of the greatest challenges for beginners is managing emotions. The fear of missing out, FOMO, during market rallies, and panic selling during downturns often lead to poor investment decisions. A disciplined approach, based on research, long-term thinking, and periodic portfolio review, is far more effective than reacting to short-term price movements. From a behavioral perspective, one of the greatest challenges for beginners is managing emotions. The fear of missing out, FOMO, during market rallies, and panic selling during downturns often lead to poor investment decisions. A disciplined approach, based on research, long-term thinking, and periodic portfolio review, is far more effective than reacting to short-term price movements.
The bottom line is both simple and profound. Cryptocurrency investing offers significant opportunities, but it demands equally significant responsibility. Success in this space is not driven by luck or speculation alone, but by informed decision-making, disciplined risk management, and a clear understanding of the evolving financial landscape.
If you found this deep and practical explanation valuable, don't forget to like, subscribe, comment, share, and hit the bell icon so you continue receiving such powerful insights on finance, investing, and the future of money.